Um, uh, we're thrilled, and I'm glad you guys are sticking around to add this to your repertoire, because it's a good bullet to have in your belt to be able to understand how these work and what the concept is. If it's a smaller intimate group, sometimes that's even better for me.
It is.
Because now you can kind of go over what you have and then answer questions personally. So,
exactly.
I'm going to stick around for a little bit. I've got to get to another appointment, so I'll probably run. I'll see you guys at the Christmas party, hopefully. If not, have a Merry Christmas. And Janet,
Merry Christmas
Merry
if I don't
Christmas
talk to you. Thank you. Yeah, no problem, no problem. Okay, so since we are a smaller group, I do want to make this conversational. So feel free to jump in and ask questions, raise your hand or whatever. Don't be afraid. There's never a stupid question. So we're just going to go over the basics of 1031 exchange. You definitely want to know about this as a realtor because it's a great way to grow your business, but you're also helping your customers, your clients at the same time. So how many in the room, just show of hands, know what a 1031 exchange is? Have a rough idea? Okay, so we'll just kind of, some of it might be a little bit too basic for some, others it may be brand new information. Did everybody get a copy of my flyer that I passed around? Okay, everybody has it, okay. So we're going to explain what it is, we're going to explain where it comes from, and go from there, okay? If it wants to. Okay, so what is a 1031 exchange? Can you see okay? Everybody can see? Okay, so it comes from the Internal Revenue Code, Section 1031, that states that a taxpayer may sell property, defer payment of any capital gains tax if that taxpayer uses the proceeds to acquire like-kind replacement property. And when we're talking about like-kind, we're strictly talking about real property. Okay, any type of real property would qualify. So if it's a vacant piece of land that your customer's selling, it's something that's appreciated in value over the years, and maybe they want to sell that vacant piece of land and use the proceeds from that sale to buy 3 condos that they can collect rents on. So in like one 1031 exchange transaction, if you're involved with that initial listing, you're helping that seller sell property, it's investment property, you're ultimately helping them to become the buyer of replacement property. So that's potentially 4 transactions that you could be involved in that you'd be collecting commissions on in one 180-day exchange period. So you can understand why this would be important for you as a realtor. Section 1031 of the code specifically states that no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. So anything that's used for personal use, like if your customer has a vacation home that they live in 6 months out of the year, that's not something they could do a 1031 exchange on, okay? This is only something used for investment because you're very limited on how much personal use you have in that property. Okay, does that make sense? Okay.
If they do it 5 months a year and the rest other 7 months they rented it out, could it be used as an exchange?
No, because you're limited under the tax rules. No more than 2 weeks in a calendar year you can use it for personal use. Unless you're doing, if you're there for more than 2 weeks, you have to show that you were there for like fixing it up and things like that. But that's the whole point of the 1031 exchange. They want you to be able to show that you use that property for investment. Okay? And does everybody understand what a capital gains tax is? We're going to kind of go over that too. Okay. So in order to qualify for this type of tax treatment where you're just deferring capital gains tax, you're not avoiding it, you're just deferring it. The IRS requires that specific rules be followed by the taxpayer when engaging in the exchange of property for other like-kind property, and those rules are set forth in the 1991 Treasury regulations that are issued by the IRS. And we'll go over that briefly as well. So why do people exchange? Obviously, capital gains tax is fairly substantial. Depending on what tax rate you're in, it's anywhere from 15 to 20%. So if you're selling a piece of investment property and you don't do a 1031 exchange, you're going to be taxed 15 or 20% on the sale of that property. So if you do a 1031 exchange, it basically allows your seller to have more money to put in towards another, better, bigger piece of property.
Within what time frame?
We'll talk about that too. That's basically, we're jumping ahead a little bit. He's asking about the time frame. You have 180 days from the date of your sale to acquire a new piece of investment property. And there's like rules around that as well. Okay, so it also allows the exchanger, we like to call them the exchanger or taxpayer, to invest into replacement property that would otherwise be, spent on taxes. They would be, instead of having, money to use for taxes, they have all that money to put towards, their next piece of property. It allows them to transfer into income producing property, like in the vacant land example that we talked about earlier. And you can diversify and minimize risk to your real estate portfolio as well. So again, it's a great thing for your customers. When you're talking to people, when you're having those initial discussions with them, you're helping them list a property. Ask them what they're using that property for. Is it investment property? Oh, have you considered a 1031 exchange? If it's their primary residence, obviously they couldn't do a 1031 exchange. But if it's investment property, it's investment property. It's a long-term investment, not a flip. Flips usually don't qualify for a 1031 exchange. That would be anything owned for less than a year. Anything a year or more would typically qualify for a 1031 exchange. Yes?
But it's only on profit made on.
It's all of it. It's all of it. So, yeah, so whenever you're selling a property as part of a 1031 exchange, in order to get that full tax deferral on the sale of that property, you have to purchase a property of equal or greater value. If you purchase a less expensive piece of property, you're still going to have some tax implications there.
So the owner has to be on title at least 12 months on property to be a 31 exchange.
On title, you said for how long?
For how long do you need to be on title?
We suggest to be conservative 2 years, but a CPA might see a year is fine. Okay? And anybody can do this. It could be an individual. It could be an LLC. It could be a corporation. It could be a trust. It doesn't really matter. Any type of entity or individual can do a 1031 exchange, but there are rules around that as well. Okay? You guys are taking notes. Okay, so these are some of the terms that you hear in a 1031 exchange. So if you've never done a 1031 exchange before, or you've never done one with us before, I would encourage you to be copied on those initial emails so you can see what the exchange agreement looks like. You can see the closing instructions that go to the title company or closing attorney handling the transaction, because you still need that. We are just the independent third party that we're actually holding the money from the sale. Whatever is left over after realtor commissions, mortgage payoffs, and things like that, whatever is left over, we hold that money until your customer is ready to purchase their replacement property. That's strictly what we do. But if you've never been involved in an exchange and you want to kind of see how the process works, you want to see what the exchange agreement looks like, just let me know. We can copy you on those initial emails. Yes, ma'am.
So I was involved from the buyer. So
Okay.
my buyer bought a home from an investor.
Okay.
I've never had dealt with 1031, and they became very nervous.
Okay.
That investor was a foreigner.
Okay.
Which kind of deferred them, which I learned a lot about that.
Yes.
In any event, how do we protect our buyers from this?
It has no impact on your buyer whatsoever. And so many people have that misconception that it affects them somehow. It does not affect them at all.
What is a good way to explain to the buyer that it has no impact? Just a very simple, it's a straight transaction, you're buying and investing.
Typically, what they should do is have a conversation with their CPA, because that's the tax professional that can give them that information. We can't give tax or legal advice. You could even have them have a conversation with me as well. I can explain the process. But I think once they understand the process and the purpose of it, I think that's the key there. What is this purpose, and how does it affect me? It does not.
The buyer does have to sign a form, though.
Yeah, there's a form.
For
They don't.
tax purposes.
Yes, but they.
That's what made them nervous.
Yeah, but it's really just to kind of put them on notice.
Okay.
That's really it. Somebody else have a question? No, we good? Okay. Okay, so these are some of the terms that you hear in a 1031 tax deferred exchange. You also hear them called a like-kind exchange. Relinquished property. So that just refers to the property that's being sold in the exchange. You could have one or more relinquished properties as part of one exchange. As long as it's the same taxpayer who's selling, it has to be the same one who's acquiring the replacement property. So you might have a married couple selling 2 investment properties, and they're using the sale of those 2 investment properties to purchase one large replacement property, okay? Or vice versa, same with the replacement property. You may have one or more replacement properties. However, with replacement property, you're limited on how many you can identify, and we'll talk about the rules of identification as well. The identification period, this is extremely important, and as the qualified intermediary, this is one of the things that we're doing, is we're monitoring the exchange from start to finish. We want to make sure that your customer is in full compliance of Section 1031. If you're using a qualified intermediary that's not following these rules, you could end up with a failed exchange. So it's important that, you know, you being here today is a testament to your clients. You know, you're willing to go above and beyond and have that education in place. So extremely important that these rules are followed to have a successful exchange. So the identification period, that starts the day that the first relinquished property closes. So if there's more than one relinquished property as part of the sale, that 45-day identification period begins the day of that closing. So your seller, your taxpayer, has 45 days from the date of the sale to identify in writing potential replacement properties that will be acquired in the exchange, okay? So that's super important. Now, if they've identified a property, they're still in that 45-day identification period, and they've changed their mind about what they've identified, they can revoke and replace the ID notice with a new one, but they have to do it within that 45 days. When we talk about 45 days, we're talking about calendar days, not business days. So holidays count, weekends count, even Christmas. So things like that, extremely important, and as a qualified intermediary, that's what we're monitoring. We're making sure that this is happening. So 45 days you have to identify. If your customer decides, you know what, they're on day 30, and they're unable to find property and they've just given up on the search, as long as they don't identify anything, they're in that 45-day identification period. Because of G6 restrictions, that basically dictates when an exchanger is entitled to receive proceeds, we have to wait for that 45-day identification period to lapse before we can release the funds back to them, and they would have to pay the tax. Okay, we can't release it even if they tell me on day 40 they're not identifying any property. Because of G6 restrictions under the tax code, we have to wait for those 45-day ID period to pass before we can give them the funds back. Yes, ma'am.
When you say identified property, are you talking about just identifying the property or having a contract in place?
Yeah, either or. You could identify by contract. We have a form, an identification form, where they can identify by address, but it's extremely important that they fill that form out correctly. If it's a condo, they have to include the unit number. The specific unit number has to be clear in the identification form. If they forget a unit number and it's a condo, it could result in a failed exchange if they don't correct it within that 45-day period. But you could also already have a property under contract as well and use that as your identification, or you could do both. I have a contract here, and I also have this form with that property address on it, but either or. Yes?
I guess you can identify different properties, 2 or 3 if you want to.
Yes.
If you need to.
Yes, you can.
So if one falls apart, then
Right. And we'll talk about that too. Yes, ma'am. Do you have a question?
she get that.
Oh, you got, okay, good. Okay, so, and then the exchange period, that also begins the day that the first relinquished property sells as well. So the day of closing starts that 45-day identification period, the 180-day exchange period. So they have to acquire what they've identified within 180 days of the sale. Okay, so it's kind of a tight time frame, but what you should be doing with your customers, if they know off the get-go that they want to do a 1031 exchange, have them be proactive. Have them go out with you and start looking at properties as soon as they know that they want to do this. Okay, that will save them. So instead of having 45 days to identify, maybe they have 90 days or 100 days. You know, whenever they start the process of looking, you want to have them do that as soon as they can. And again, they can have a new property under contract at the time that they engage us in the exchange. That's not an issue. We just have to make sure that the timing all works out. Yes.
What if, say, they have something under contract within the 45 days and then it falls apart because nothing else will ever get within that?
If they're past are they past 45 days or?
Well, no, let's say they have something and it falls apart for some reason, inspections or whatever, and they don't have another one.
Yeah, if they don't have another one and they're past that, if they don't have a backup property on their ID form and they're past that 45-day identification period because of G6 restrictions, we have to wait for that 180-day exchange period to lapse, and then again, we would have to release the proceeds and they would have to pay the tax, unfortunately. Okay, so hopefully that doesn't happen.
What about if a property is sold with a loss? Actually, they paid more for it than what they sold.
That would be a question for to have with a CPA. Is it even worth it to do the exchange? If it's in your long-term investment goals to keep buying up in value, you may still want to consider doing the exchange. But if it's a one-off type of thing, it may not even be worth their while to do it.
Because I had a situation when the purchaser of the land assumed that the prices keep going up, the prices
Mhm.
go up, meantime they just keep paying taxes, and after that they get title.
Yeah, I mean, you can have no
Exactly.
profit but still have gain, you know, so that capital gain.
But I
So
don't know for what they bought it and what they sold it for, it was a loss.
yeah, that would be a question, like, because again, we can't give tax or legal advice. They want to have that deep discussion with the CPA or their tax attorney or whoever's helping them with their taxes, just to make sure it even makes sense. Because even when we're having the initial conversation, if it seems like it makes sense to do the exchange, we're still not going to give them, tell them, okay, definitely go ahead and do this. Still have a conversation with the CPA always, okay? And never even, as you know, as the realtor, you don't want to get yourselves in a situation where people try to get you to give them tax or legal advice, because that does come up. Okay? People sometimes want you to tell them what they want to hear, unfortunately, so you have to make sure that they're getting the best advice that they can.
Sir, and what happens if they identify the property before they sell the current property that they own?
That's fine. They could do that.
So they can make a contract on the property that they want to purchase it.
Yes.
With the contingency of selling the.
Exactly. And that's to keep it as something called a forward exchange, where you're still able to sell first and then use the proceeds from the sale to purchase. There's also something called a reverse exchange, where they could potentially buy first before selling. And there's different rules around that, and we'll talk about that when we get to that part. Okay, these are the rules in a 1031 exchange, because we can't distribute the PowerPoint. If you want to take a quick picture of this, this is kind of the basic flow for how this is supposed to work, okay? This is for both of your, more of your standard run-of-the-mill transactions that we're talking about. We're pretty much talking about the forward exchange because that's the most common type of exchange. You may want to take a picture. Okay, so no, rule number 1, properties being sold and purchased must be held for investment purposes. Primary residences do not qualify for Section 1031. So sometimes we'll get people asking us questions about that. This only applies to investment property, okay? Number 2, you must use the services of a qualified intermediary. That's us, that's what we do. Your customer's attorney cannot act, anybody who's acted as an agent of the taxpayer in the last 2 years could not act as their qualified intermediary. That would be their attorney, their personal attorney. That would be their CPA. Anybody that's been working for them as an agent in any capacity in the last 2 years cannot be the qualified intermediary, because it could cause them to have a failed exchange, because they would be considered to be in either actual or constructive receipt of funds, which we don't want that to happen. Number 3, the exchanger must not have constructive receipt of funds. Does everyone understand what that even means? Constructive. I mean, actual receipt of funds, we know what that means. You're physically have the money in your possession. Constructive receipt is basically if you had your attorney hold those proceeds or somebody like that. That would put you as the seller in constructive receipt of those funds. You don't have direct access, but you have constructive access. Number 4, an exchange agreement must be entered into prior to the closing date of the relinquished property. No exceptions. So if it's day of closing and you find out that your customer wants to do a 1031 exchange, they tell you last minute, please let me know. If it's a traditional forward exchange and it's a pretty simple transaction, more often than not, we can set that exchange up in less than an hour. Believe it or not, we can actually do that. If there's an entity involved that's selling, like an LLC or a corporation or a trust, you know, it may take a little bit of extra time, but we could probably still pull it off the day of closing. If they've already closed on a transaction and they mention they want to do a 1031 exchange to you, it's too late at that point. Once the property has conveyed to the purchaser and, you know, money has changed hands, it's too late at that point. There's no exceptions to that. So you have to be wary of any qualified intermediary that says, oh no, we can still do it after closing, because that's not a thing, okay? Just so we're clear. So exchange agreement has to be in place prior to the closing, even like an hour before, okay? Number 5, the taxpayer must identify in writing the potential replacement properties that will be acquired in the exchange. We've already talked about that. Number 6, the taxpayer may not have access to any of the exchange proceeds during the exchange period. However, if they need an earnest money deposit to come out of the exchange proceeds to go towards the new property, we can send out the earnest money deposit out for them on their behalf. If they need proof of funds, if they don't want, you know, God forbid, they don't want the seller of this new property to know how much money that they actually have to buy. You know, that's a negotiation strategy for some. We've had exchanges fall through because, you know, people were aware of all of the funds. If they only want them to know that they have access to a certain amount, we could do a statement for them, okay? They have access to this amount in their exchange account instead of showing the entire proceeds from the sale. The account summary can be provided as well as proof of funds, but that would show the entire amount. We could not provide the account summary to you as the realtor, but you can request it on behalf of your customer and we can send it to them and then they can do whatever they want with it. Let's see. Number 7, the taxpayer must purchase a replacement property within the 180 days of the close of the relinquished property. So that's pretty much it. It's pretty simple. I mean, we still have a little bit more slides to go through, but that's your pretty straightforward 1031 exchange. This is how it's supposed to work. It's pretty simple. Yes, ma'am.
One question, with the money or the proceeds that they get from the relinquishment of the property, say they want, instead of buying one property, they want to buy 2, but they use up the money, is that okay?
Yeah, that's fine. And what they could do is that, use all the money from the sale, and then if they want to finance the balance, they could do that as well. Okay? So say they're selling a property for $100,000 and they want to buy 2 properties for $6,000. They could certainly finance the remainder. That's not a problem. Yes?
So the buyer is being charged for your services, I think.
Yes. The seller who becomes the buyer, yes.
Okay. What is the percentage or how do they
Well,
calculate that cost of that service?
It's based on the type of exchange, and it's also based on the number of replacement properties they're acquiring and things like that. So when we go through the different types of exchanges, we'll talk about fees. And here's another thing to be mindful of. What we do is unregulated. Okay, being a qualified intermediary is not regulated like the title industry is. So you may see a variance in things as far as processes and things like that. Fees will vary amongst qualified intermediaries, but I think we're pretty competitive. But the key factor is just make sure you're working with a company that's reputable. There's a lot of good companies out there like our company, but there's also a lot of bad too. So you want to make sure that they have the proper insurance, and we'll talk about that, and we'll talk about fees. This is just the delayed exchange timeline. If you go out on our website, we have calculators for this. It's just oldrepublicexchange.com. And you go under the resource tab, you can actually plug in 45 days. You can plug in 180 days, just to see where that's at. But once your customer closes on their relinquished property, we will be giving them those dates. Okay, so you've closed this date, here's your 45-day identification period, here's your 180-day exchange period. We're monitoring this as well, so this is just information. And then if we're not hearing from your customer, say they're on day 20 and they have not submitted an identification notice yet, we're going to call them, we're going to email them, we're going to send them reminders, we're going to follow up and follow through to make sure they're in compliance and they're still sticking with these time frames. Same with the 180-day exchange period. Say we received a contract, but we haven't heard anything else, we don't have the closer's information, we're going to follow up for that information just to make sure that this gets done promptly and on time. These are the rules of identification. There are 3 rules. The first 2 are what most people go with. The third rule, we're talking about it here for educational purposes only because it's not really something that we ever encourage people to do, and I'll tell you why. So the first rule is the 3 property rule. That's the most popular. You can identify up to properties of any value. So again, like in the example we talked about earlier, you could sell a property for $100,000, purchase a new property for $600,000 and finance the purchase. You could have the intention of only buying 1 property, but maybe you want to have 2 backups. If that's your situation, you want to use the 3 property rule. I intend to buy only this property, but then I have these other 2 if the first one falls through. So, you're on day 46 and, the 1 property you really wanted to buy, the contract fell through, something happened, well, at least you have these other 2 to work with. So 3 property rule would most likely work for you, and you're not limited on value. There's also something called the 200% rule. You can identify any number of properties without regard to value as long as the fair market value of the properties being acquired are not double in value to what you're selling. Okay, so if you're selling for $200,000, you can't go more than $400,000 on your replacement properties. So you're limited on the value, but you're not limited on the number of properties. And when we talk about fair market value, we're not talking about appraisals or anything like that. Whatever the contract sales price, that's what we're determined, that's what we're using for our figures. So if you submit an ID notice and you're using the 200% rule of identification, you have to have the values there. And if your values don't add up, then our legal department will send it back to your customer and say, hey, you've over-identified, you have to correct this, okay? So they're pretty strict on that. Yes?
So you're saying like if the property is 500,000, the max they can go is $1 million?
Correct. Correct. Okay, and we're going to be looking at that form. If they submit a form and they're just a little bit over that, they have to go back, reevaluate what they've identified and make sure that the numbers add up. Okay, pretty simple rules. The 95% exception rule, that's any number of properties without regard to value, provided that 95% of the value of the identified properties is acquired. The problem with that is people get too aggressive and they identify too many properties. And what happens is properties go under contract out from underneath of them, somebody else gets the property, they're not able to acquire 95% of what they've identified, resulting in a potential failed exchange. We've had 2 attempted this type of rule of identification in the history of our division, which we're a subsidiary of Old Republic International. We've been around for 35 years, and 2 transactions, they tried to do this rule of identification, both failed. So we don't even really go over that because for everyone else, pretty much the 3 and 200% rule is going to work for them. And we have an e-report on this as well. It kind of goes over this in more depth and explains this. We do e-reports every month as well on pretty much anything related to the exchange. So if anybody wants on that list and wants access to that information, let me know after the class and we'll talk about that. So what is like kind? Again, we already know Section 1031 only applies to real property. So this is just some examples. Any type of property used for investment, for trade, or in a business. Raw land for a shopping center, an apartment building for a shopping center, a hotel for a farm, that would be interesting, vice versa. Single family for multifamily, vacant land for single family. You kind of get my drift where I'm going with this, okay? So I had someone sell a piece of, it was like a luxury home actually, out in the state of Washington, like $1 million property. And what they were doing with the funds is using that property to buy vacant lots up in Homosassa. Does everybody know where that is? It's like some kind of luxury RV park. So they were buying multiple lots. And think about it, I mean, that would be an easy investment, you know, and very minimal maintenance. They would have to have somebody come out and cut the grass and kind of maintain it. And the people that are renting those lots, they're luxury RV owners. They're going to take care of the property. So that's kind of a neat investment, I thought. You know, it was actually something I was considering doing myself, you know, but it's just something, there's so many things that you can do with a 1031 exchange and move your money around that, you know, you have to think about it, really get creative, okay?
You can't do from vacant house to vacant land and vice versa. That's
Exactly.
considered like
Yes,
property.
as long as
I
it's,
thought it had to be house and house or con.
no, yeah, and that's,
I thought land and house was different.
right, and that term like kind was put in the tax code when it was initially established, because when it initially began, it started with farmers, believe it or not, and initially they were doing exchanges of livestock, believe it or not, of the same sex, so a cow for a cow, things like that. It evolved in a personal, and that was considered a personal property exchange, so they could defer capital gains tax on the cow. So you have, it evolved from cows to tractors to automobiles, and then eventually real property was included in on that as well. But as of January 1st, 2018, they eliminated personal property exchanges from the tax code. So we're strictly just talking about exchanges of real property. But that term like kind, you'll hear it called a like kind exchange, is kind of confusing to people. But it's any type of real property. Yes, ma'am.
This is a weird question. Let's say that you have a building and you want to buy a single family home
Yes.
for income.
Yes.
You already own the home. That's okay as long as you don't move in the home.
Right. Well, here's the thing. If you buy, say, her example is you're selling a building and you want to use the proceeds from the building and buy a single family home. Okay, with the proceeds, that's fine. And as long as you're using that investment, that single family home for investment for at least 2 years, again, 2 years is us being conservative as the QI, a CPA might see a year is fine, and maybe eventually you want to make that property your primary home. But you have to show that you've used it for investment first. That's the key. 2 years, that's the conservative approach. Again, to have a conversation with the CPA, they may suggest otherwise, but after they've used it for 2 years for investment, they could certainly convert it to a primary home at that point.
And does it work too, let's say that somebody has a building and they want to buy a single family home and they're renting? And it's the same thing. They have to have it at least for 2 years.
Yeah,
Does it matter
No matter what, yeah, yes. Both properties have to be held for business purposes or for investment.
It won't be invalid if at least 2 years is rented.
Right. Now, if they sold that business, not business, but if they sold the building, the commercial building, and they bought the single-family home and they immediately try to move into it, if they get audited by the IRS, they're going to end up paying the tax. Okay, does that make sense?
So it would work if they move in after 2 years?
Yes, but they have to use it for investment first.
Deferred, but then if they sell it.
Well, it would just go, at that point, if they move into it, it would become their homestead, and then they wouldn't have to worry about.
The other rule of the.
Yeah, then you got to talk, yeah, that's a
It
whole,
won't be deferred.
yes,
Part of the amount that they purchased it.
yes,
Will be deferred.
correct. They would not have to worry about that.
Let's say they bought it for 3 and they sold it for 6.
Mhm.
The 3 that came from their original property will be deferred.
You're still deferring, yes, ma'am. We're just talking about this here for educational purposes. This is just property excluded from 1031 tax treatment because questions do come up. We already know it only applies to real property. This is vacant land or home or buildings, strip malls, whatever. So no stock in trade or other property held primarily for sale, bonds or notes, other securities or evidence of a indebtedness or interest. Interest in partnerships do not qualify for Section 1031. Certificates of trust or beneficial interests, buying interest in a business, things like that, that does not qualify for Section 1031. And personal property exchanges, like we said, were eliminated from the tax code as of January 1st, 2018. And just, before anybody asks me, this question's come up in other classes, can I exchange my spouse? Okay, just so we know, just for clear, and throw a little comedy in there. You can't exchange your spouse, your kids, or your in-laws. Okay, just throwing it out there. Someone actually did ask me that in a question. Nope, can't upgrade. Okay, so this is where we'll talk about the fees. This is the 4 methods of exchanging. So the first method is what we've been talking about. That's called the delayed exchange or the forward exchange. Okay, this is where you're selling property, and within 180 days of the sale, you're purchasing replacement property. So the delayed exchange, depending on the number of relinquished properties and depending on how many replacement properties, you're looking at roughly anywhere from $750 to $1,500 on the sale of the relinquished property, and that's based on the contract sales price. There's not a percentage, so it's like a tiered system. So anywhere from $750 to $1,500 on the sale to $375 on the purchase of each replacement property, plus $35 for each incoming and outgoing wire. Again, our fees are pretty competitive. Don't go on Google, and search for QIs that way. It's really best to talk to an accountant or an attorney and try to get referrals from them if your customer doesn't have a QI or wants to kind of price check and things like that. They can come to me, but they can also feel free to go out and do some research and see what else is out there. But that's roughly where it is, anywhere from $750 to $1,500 on the sale, $375 on each purchase plus wire fees. The simultaneous exchange, this is where you're selling and buying all on the same day. You can save a little bit of money on a simultaneous exchange. Most of these run around $1,000 flat, and there's no wire fees. We're not actually holding the proceeds in a situation like that, but we're still preparing the exchange agreement to put everyone on notice that this is part of a 1031 exchange. We're still sending closing instructions to the title company or closing attorney handling the closing. And again, $1,000 roughly for most of these, but it could be as small as $750 flat or as high as $1,500 flat, depending on the contract sales price of the properties being sold and purchased. So another consideration there as well. The reverse exchange. Now, when we talk about reverse exchanges, sometimes people have to go that route for some reason or another. They don't have their property under contract, but they found this great property that they want to purchase. They don't want anybody else to get it, so they do something called a reverse exchange. You still have to have the exchange agreement in place with the qualified intermediary when doing a reverse exchange. So if you have a customer that's considering doing something like this, have them notify the QI as soon as possible, because it takes roughly 2 weeks to set up a reverse exchange file. I could actually teach a class just on reverse exchanges because it is so complex, and the fees are much higher on a reverse exchange. You're looking at anywhere from $6,000 to $12,000, depending on what's involved. Is it an LLC selling? What are we doing? Because at any point in the exchange period, the seller or the taxpayer can't hold title to both properties at the same time. So we either have an exchange accommodation title holder, or they call it an EAT, come in, and they're either taking title to the relinquished property or the replacement property throughout the exchange period. So there's additional fees for that as well. There's an application that needs to be completed also, and there's just, like I said, multiple steps, and we actually have a reverse exchange department that's all they do is handle these type of exchanges. But they are very time consuming, and if it's a situation where they can be flexible with dates, and we're talking to your customers, and maybe they have both properties under contract, I'll have them consider, hey, do you really want to do it this way? How about you consider a simultaneous exchange? Or maybe we switch this over to a forward exchange, because we want them to save as much money and have more, bang for their buck, obviously. We're not going to put them through the torture of setting up a reverse exchange if it's not even necessary. So as we're talking to people, but the thing with the reverse exchange, you do have to make sure, I tell people, if you don't already have your property listed, get it listed, get it out there, start being aggressive with it, because you have to sell your relinquished property within 180 days of the purchase of the new, okay? So the beauty of the reverse exchange, you don't have to worry about that 45-day identification period. That goes away, but you still have to make sure that your property sells within 180 days, okay? Construction or improvement exchanges, this is where you're selling your relinquished property and then using an exchange accommodation title holder, that's that E I talked about, to come in and acquire and hold the replacement property while proceeding to construct capital improvements. Upon completion of the improvements, the replacement property is then conveyed back to the exchanger. So your customer can actually save money if they buy a property that's new construction or needs major improvements. If they do an improvement exchange, any money used towards those improvements will be deferred as well. Okay, so it's a great concept. Again, these take a little bit to set up. We're looking at a week and a half, 2 weeks again. There's an application, and they cost around $7,500 to set up, because you have payments that go out to the builders and things like that. And another caveat is the improvements have to be 180 days of the sale of the relinquished property. So you're in a tight time crunch. We have to make sure that everybody's communicating, everybody's on the same page, and those improvements have to be identified within 45 days of the sale of that relinquished property. So you still have those time frames to adhere to, but it's still an option for customers looking at new construction, okay, spec homes, whatever. Any questions about these, the types of exchanges? For those of you that knew about exchanges, did you know there was more than one? No? So you learned something today. And these gives your customers options too. Just to recap real quick, these are the benefits of the 1031 exchange. Obviously, defer capital gains tax. If you buy a property of equal or greater value and use the proceeds from the sale, you can fully defer capital gains tax by doing a 1031 exchange. You can choose also to do a partial exchange. That's not really the goal, but if you want to buy a less expensive piece of property, and there's not really a huge amount of difference between the two properties, you would have to still pay tax on the difference, but it's an option as well. So if your customer finds something that's a little less expensive and they want to go that route, they could certainly do a partial exchange. If they know up front they want to do a partial exchange because of G6 restrictions and their limitation on access to funds, I would encourage them to talk to the title company and say that I only want to use this specific amount towards my 1031 exchange. Any extras should come out at closing, otherwise we have to hold all of the proceeds and release the remainder at the end of the acquisition of the new property. Okay? It allows the exchanger to leverage for wealth building, which we already talked about, like in the vacant land example, selling vacant land, buying something you can collect rents on, things like that. Relocate assets, estate and tax planning. Believe it or not, I have people that are long-term investors. Their primary goal is to keep doing these 1031 exchanges until they pass away, and then the property passes on to their heirs on a stepped-up basis. So all that tax is forgiven. So when you get the property, you're the heir, and you get that property at a stepped-up basis. That basically means you get the property at whatever the fair market value is at the time of the owner's death. Okay, so it's a great way to leave something for your children. I've had heirs of investment property do 1031 exchanges on them because eventually it became their investment property, and it's just kind of continuing the cycle. So definitely, if it's something that you're looking at in your long-term financial goals, investment goals, talk to your estate or tax planner and tell them, hey, how can I make this 1031 exchange work into my, estate, into my estate planning? How can I make this work for me? So something to consider as well, because it's doing more than, you're leaving things to your children or grandchildren. These are the potential hazards in a 1031 tax-deferred exchange. These are some hazards. These are the most common hazards that we run into as the qualified intermediary. So when we get the contract in from you as the realtor, we're looking at the contract. We're going to compare whoever is listed as the seller. We want to make sure that that matches title as the vested owner. Okay? We're looking, or whatever you're providing to make sure it matches the contract. So, for example, say it says John Smith is listed as the seller on the contract that you can provide to us. John Smith is listed as the seller. We get the title commitment in from the title company or the warranty deed, whatever you're providing, and it says John Smith LLC is actually the seller. Okay? At that point, we need to get a correction to the contract, and then we have to get those documents that make up that LLC to find out, to make sure, just because it's John Smith LLC, we want to make sure that John Smith is the authorized signatory for the exchange. We want to make sure there's an operating agreement in place. We want to make sure there's that the company is active on Sunbiz. So we want to make sure it's an active LLC and that whoever is listed as the authorized signatory in the LLC documents is also signing our exchange documents. Okay, so that's what we're doing as the QI, making sure, vetting all that information. Same with marital issues. Again, you have John Smith. Yes, ma'am. No, you're fine.
If you have John Smith selling,
Yes.
does it have to be John Smith buying?
Mm-hmm.
Can be a
Nope.
extra person?
It has to be the same taxpayer who sells, has to be the same one who acquires. In her example now, if John Smith was selling a property for $100,000, okay, and he was using the proceeds of that $100,000, he's an individual selling, and he wants to buy into a new property with a partner. As long as he's using his full $100,000, maybe purchasing a 50% undivided interest in the new property, the partner can take the other 50% interest. The money, someone else's.
His wife to the new property.
Unless she did it in that situation. If she was contributing equal money, she could do that. But for those situations, usually it doesn't work that way because your money is coming from, you both are sharing money. So he would basically have to maybe add her at a 1% interest and then change that to make it equal later. It's a whole thing, but they do come up. Yes?
What happened in this subject if John Smith is a private owner, becomes business and doing business as, and wants to retitle the new purchase property?
The only way he could do that is if it was a single member LLC. If he's selling as an individual and wants to buy into the next property in the name of his LLC, he could only do that if he was the sole member and it's a disregarded entity for tax purposes. Everything's still pointing back to him as the individual, as long as it's set up that way. Same with if he was selling that way. Say he was selling in the name of his single member LLC, it's John Smith selling single member, and he wants to purchase in his individual name, he can do that. Okay, same with trusts. It's the same way. If it's a revocable trust, they can sell in the name of the trust, purchase in the name of, if it's a married couple, they could purchase it as individuals at that point. But for the most part, it's usually the same taxpayer who sells has to be the same one who acquires, with certain circumstances where that might vary a little bit. But marital issues, say again, you have John Smith selling on the contract, you get the title commitment in or the warranty deed, whatever you're looking to confirm vesting, and you see that John Smith and his wife Betty are actually entitled, but Betty's deceased. At that point, there's additional requirements that have to be added to the title commitment that state that Betty's interest passes on to John and things like that, because sometimes people die and they don't do anything with the deeds. They just kind of let things sit. So we want to make sure that all that's taken care of. We may even ask for proof of death for Betty just to make sure everything's on the up and up. Partnership interest, this gets a little complicated. You may see these even with the things you're dealing with, because with a 1031 exchange, it's not always large commercial transactions. That is a common misconception. People think that it's always some kind of big multi-million-dollar deal, and that's not the case. you're looking, most of the 1031 exchanges that I do are around $300,000 or less, okay? And these could be a residence, you know, owned by a married couple. They could have it set up under an LLC, because a multi-member LLC, because they don't want the liability on their personal name. So they might set it up that way. But it's not always, like I said, a large commercial transaction. Most of them are going to be smaller, with some exceptions. But partnership interests, this would come into play, and I'm going to give you the short version. We actually have an e-report that covers all this as well. But say you have a 2-member LLC. They've owned a property for 25 years as the 2-member LLC. They want to go their separate ways. One partner wants to cash out and pay the taxes. The other one wants to move along and do a 1031 exchange with their share of the proceeds. What they do is, just prior to the sale, is they convey the property to themselves as individuals, as, you know, with a 50-50 interest, tenants in common interest. And when you do that just prior to the sale, it can invalidate the holding requirements. Because again, what I said earlier, you should hold a property for 2 years prior to selling as part of a 1031 exchange. If you do anything with title just prior to the sale, it could invalidate things. And the IRS, if you're audited, could come back to this and say, you know what, you as an individual did not hold that property long enough for investment, especially if it's like just before closing or a month. So if you're talking to customers and they're in that situation, have them deed out of title from the LLC into themselves as individuals as far in advance as possible, to prevent any issues with the holding requirements, okay? That's extremely important. So when that does come up, we do, you know, educate people on this, you know, tell them, hey, go to your CPA to make sure, you know, about that, if you really want to do this, because again, you know, you could cause a risk, a hazard to your exchange, and end up having to pay taxes anyway. So extremely important when we're talking about partnership interests. Carryback financing. This is where the seller of relinquished property carries a note for the buyer. Now the issue with that is the note has to be in the name of Old Republic Exchange, and we have to review the note and all that good stuff. If it's in the name of the seller, it's definitely going to cause issues and could end up having them pay the tax anyway. They could be, you know, having to pay mortgage boots. So that's something you really have to be careful that it's done properly. And there's additional fees when it's carryback financing. We don't get too many of those, and we do have e-reports again on this situation. But when they do come up, it's usually an additional $500 on top of our normal exchange fee, because there's additional steps that need to be done to make that happen. So seller carryback financing is an option, but you have to make sure that it's done properly. Repair work. I know a lot of people fix up a property just prior to selling as part of a 1031 exchange. Investors, they want to put new flooring in, carpets, what have you. Well, they think that they can recoup those costs before purchasing the replacement property. If they hold back any money from the exchange, they're going to be taxed on that amount. So say they wanted to hold back $10,000 for new carpet or new flooring that they put into the property because they feel like that money is owed to them. To get the full tax deferral, you have to buy something of equal or greater value, meaning you have to use all that money towards the purchase of the new property. If you put new money for flooring in, forget about that, just put it into the next property. Otherwise, you hold $10,000 back for repair work, you will pay the tax. If you're the realtor on your own 1031 exchange, you're the seller, but you're the seller and you're the realtor too, I would encourage you not to even take commission. You're entitled to your commission no matter what, but if you know what you're going to do with that money anyway, put it into the next property. So you can keep buying up in value. But that's just things to consider, and that would be a question for your CPA. What would make the most sense? Do I keep this money? Do I keep a portion of it? What should I do? Related party transactions. So this would be buying and selling from a related party. Both parties still have to do an exchange. When I tell people that, sometimes that kind of goes away. But say, for example, you have a mom selling to her son, and the son turns around and flips mom's property. He could cause his mom's exchange to fail because he did not hold her property for investment. So it's important that we communicate to people considering these related, and we're talking about immediate family members. This is, when you get into in-laws and things like that, I don't think that they look at those too closely. But when it's, mother, son, father, daughter, brother, sister, things like that, you just want to be careful and make sure that they're following the rules, for related party exchanges. And there's, again, an e-report that we could provide on that. Non-exchange related costs. As we're talking to your customers, We're talking about things that could potentially affect how much they have to reinvest. So we're looking at mortgage payoffs. We're looking at other liens against the property, realtor commissions. Maybe people forget all these things that are tied to the sale of this property. And maybe at the end of the day, it doesn't make sense for them to do the exchange. So we kind of go through the whole transaction. Are you paying off any mortgages? How much are you going to have left over? How much are you looking to reinvest? Things like that. But maybe at the end of the day, it doesn't make sense for them to do the exchange, and they don't move forward because they haven't considered all the other costs related. Holding requirements, again, one of the first questions we ask your customers besides, what are you using that property for? It's investment. How long have you owned it? Have you owned it for more than 2 years? Great, let's talk about a 1031 exchange. If it's, I've only owned it for 3 months, it was a flipper, I fixed it up. Okay, I don't think this is gonna work for you. But the problem is, again, because what we do is unregulated, where I may say, be more conservative and say, hey, let's not do this because I'd rather have your business for future, for something that makes sense. You might have another qualified intermediary, someone that's not on the up and up, and unfortunately, you have that in this kind of industry. They may say, go ahead and do, oh no, you can go ahead and do this because they just want to collect that fee. They don't care. So I care about the customer, I do, and I care about you, as the realtor. You want to make sure that this is something, because it can come back to you. Whoever you're referring people to is a reflection of you. If you refer a bad qualified intermediary to your customer, they're going to come back to you and say, why'd you send me this guy? He messed up my exchange or something like that. So you want to make sure that whomever you're working with is following the rules and doing things that make sense, okay?
I don't know if I missed it when I had to step out. What is the fee? Is it based on the price of the property and stuff?
It's
Almost like title fees?
the type of exchange. Do you remember we were talking about the delayed exchange and the fees with that? So if it's we'll just recap real quick on the fees. So on the delayed exchange, this is where you're selling first, and within 180 days you're purchasing. It's going to be anywhere from $750 to $1,500 on the sale of the relinquished properties, provided on the contract sales price, and then the number of replacement properties, you're looking at $375 for each of those. If it's a simultaneous exchange, it's going to be a flat fee schedule, around $1,000. Never try to quote a fee. If you want fee information, you need it immediately, send me, give me a call, ask me, what's the contract sales price, how many properties they're buying. If it's a reverse exchange, we know it's going to be a lot higher, around $6,000 or more. If it's an improvement exchange, it's going to be $7,500 or more. So depending on the type of exchange, the number of properties involved, we can give you a fee quote from there. But whatever fee quote I give you, we'll stick with it. It's not going to change. Real quick, this is what we do. We're almost done here. So we act as the qualified intermediary. That's what we're called, QI, as required by the Treasury regulations. This just means that we acquire the relinquished property, or RQ as we like to call it, from the exchanger and transfer it to the buyer, and we acquire the replacement property and transfer it to the exchanger. We prepare all documents necessary for the exchange. That's that exchange agreement, the assignment of sales contract for the relinquished property, the assignment of sales contract for the replacement property. We consult with the exchanger's tax advisors. We have no problem doing that. Again, we still have to have an ultimate conversation with your customer as well. We have to make sure that they want us to do this exchange for them. We execute closing documents as principal, as the seller in the relinquished closing, and as buyer in the replacement closing. We hold the exchange proceeds to prevent the exchanger from either actual or constructive receipt of funds. And we all know what constructive receipt of funds is now, right? Everybody knows. So if it's like you're not holding the money yourself, but somebody that's been an agent, like your attorney or your CPA is holding that money, you have to have the qualified intermediary do it in order for it to qualify for an exchange. We coordinate with closing agents, real estate agents, tax and legal advisors. So we pretty much do it all. We manage the process from start to finish. We're monitoring the exchange timelines. We're keeping your customers in full compliance with Section 1031. So when selecting an intermediary, again, this is extremely important. You want to make sure that your customer is vetting the financial security and strength of the company that's doing the business for them, okay? You want to make sure they're not like some, fly-by-night. You want to make sure that they're experienced and they know what they're doing. And you want to make sure they're in full compliance with Section 1031. You being here today, you know the basic rules involved. You know that an exchange agreement has to be in place prior to the sale, right? If you're doing a traditional delayed exchange. If you're doing a reverse exchange, you know that exchange agreement has to be in place prior to the purchase. Okay, so before anything happens on any transactions, get that exchange agreement in place, get them in touch with a qualified intermediary, whether it's us or some other company, and make sure that the company that you select or your customer is selecting is experienced. Okay? Old Republic Exchange has done hundreds of thousands of these exchanges in the 35-year history of our division. And I'm proud to say we've never had an issue at audit for something we've done. And not a lot of companies, I got to knock on wood from somewhere. Okay, just keep it lucky. Because you just never know. I mean, but we've been doing this for a long time. We have a legal team that's overseeing all of the exchanges. We have experienced account managers, people that know what they're doing. So you just want to make sure that whoever is working on this exchange, that they have the experience and they know what they're doing. Old Republic Exchange's parent company is Old Republic International. It's a Fortune 500 company. Everybody's heard of Old Republic title. We're a sister company of them. But Old Republic International is a Fortune 500 company. We recently rang the bell at the New York Stock Exchange, which was pretty exciting for our company. So we just did that recently, and there's a whole video about it. Old Republic Exchange has a $60 million errors and omissions policy and a $120 million fidelity bond covering acts of dishonesty or fraud. We have the highest coverage in the industry out of every other QI out there. So we just recently increased those numbers, so I was super excited about that. So when you're talking to intermediaries, even when I'm talking to your customers, they say, well, you know what, I want to shop around and check prices. That's fine. But whomever you're shopping around with and checking with, ask for what is their errors and omissions coverage? What is their fidelity bond coverage? We also have a hold harmless or a letter of indemnification that we can provide as another added layer of protection for the exchange. Where are they holding this money? What are they doing with this money? We only deal with certain banks. We only deal with certain, and all the money is put into pooled accounts. So basically, all the banks we deal with are FDIC insured. That's anything up to $250,000, you're getting your money back. But if you put it in pooled accounts, you're spreading that money out. So nobody's money is ever sitting with one bank, because in the event, for God forbid, that bank fails, they're going to lose their money. So we have it structured in a way that, some money will be in this bank and some money will be in this bank. So at the end of the day, their money is safe. So just in case anybody was curious, yes. Who? Do I really want to tell you that? No, okay, so most of your reputable QIs will have an associated title company, if that gives you any kind of indication. So you're looking at First American, Fidelity, companies, anybody like Old Republic Title, is our title company. But we can actually work with any underwriter. So even if Fidelity is handling the transaction, Old Republic Exchange may have already been selected by the seller to act as the QI, we can still work with them. And we work with a lot of underwriters that don't have an associated 1031 company, like I think Westcor is one of them, or some of the smaller ones, North American. They don't have 1031 companies, so they often will call us and we can help them. But yeah, any of your reputable ones are going to be tied to a major title insurance underwriter, always. And if you have somebody recommending one of those, go with them. Don't go with anybody on Google, because I will tell you this, you get what you pay for. So if somebody's saying, oh, I can do this for dirt cheap, $250, they can also steal your money too. So you want to make sure that they understand what they're doing. But any other questions? That's my contact information. I'm actually doing the same class tomorrow on the web. It's a free webinar, so if you have any colleagues or customers that you think would be interested in hearing this in a live conversation, it's a free webinar. It's from 10 to 10:30 tomorrow morning. Give me your card and I can send you the link for it. I'm also on LinkedIn, and any information that I share on LinkedIn, you can share with your customers. Feel free to put it on your pages. It's not just marketing material, but it's education-based. So like when we were talking about the reverse exchanges, I might share an e-report on reverse exchanges. It kind of details how that's supposed to work. Identifying property, I have an e-report on that. The exchanges of vacation homes and things like that, I have an e-report on that. Pretty much any subject you can think about that involves a 1031 exchange, I have an associated e-report. FIRPTA, real quick, any foreign sellers. I mean, we get a lot of foreign sellers, especially here in Florida. If they're doing a 1031 exchange, unless there's an exception to FIRPTA, FIRPTA still applies. Okay, there's that FIRPTA withholding, it's either 10 or 15%. Just because they're doing a 1031 exchange doesn't make that go away. Okay, but they can still, it still may be a benefit to them even as a foreign seller, because they're still able to defer anything outside of that amount that's being withheld. Okay, so it's still, might work for them, especially if it's a very large transaction, but have them talk to me. I have any report on FERPTA. If you need it, need that information to share with your customer, let me know. But that's my contact information. It's on the handout, and I think everybody has my business card as well. Yeah, and if you ever have questions, don't ever feel like it's a stupid question. Send me a text. Send me an email or give me a call. You can answer any questions, and we'll answer it quick. Okay? Thanks for listening. All right. You may continue on your day. Go get those exchanges.